Good afternoon, everyone, and thanks so much for taking time out of your day to join us for this discussion, examining the 2024 election and the potential impact on financial markets and the economy. I'm Sean Neary, the co-lead of U.S. Financial Services at Edelman Smithfield, and I also lead our Washington, D.C. office. We're joined today by Sam Sutton, the author of Morning Money, Politico's daily newsletter covering the economy and financial regulation, and really an essential read for both Washington and Wall Street. Let me take you through the next hour. Sam's going to moderate what I'm sure is going to be a lively conversation featuring Kathy Bostjancic, Chief Economist for Nationwide Mutual, one of the world's largest insurance and financial services companies, and Philip Straehl, the Chief Investment Officer for the Americas at Morningstar Wealth and a leading provider of advisory services. But before we get into the panel discussion, my colleague Lisa Leiter, my partner and the co-head of U.S. Financial Services at Edelman Smithfield, will share the results of a pulse survey that we recently conducted looking at how institutional investors feel in wake of the 2024 election. Lisa, over to you.
Thanks, Sean. I want to thank Sam and Kathy and Philip for participating in our panel today. And before we begin that discussion, we're going to share the insights from our new pulse research on the institutional investors' market and economic outlook as we head into the new year. So we worked with Wakefield Research to poll 200 U.S. institutional investors last month in the week following the election. More than half of these investors manage $1 billion or more in assets. And the top headline, as you can see here, investors are overwhelmingly confident in President Trump's ability to grow the U.S. economy. 80% express a good deal or even complete confidence in his ability to grow the economy. It's worth noting that those in the most senior leadership positions, those in vice president and above, are even more confident than their counterparts at the manager or director level. 86% have a good deal or complete confidence compared to 67% of managers or directors. And this is all despite the uncertainty surrounding Trump's trade policies. So as with their confidence in Trump to grow the U.S. economy, institutional investors are also overwhelmingly optimistic about achieving target returns over the next 2 years. 91% are either somewhat or very optimistic. Here on the next slide, it may come as no surprise then that nearly 3/4 of the respondents said that they plan to increase their investments now that Trump has won the White House. And that could involve a number of things, including adding to their cash holdings. 41% said they'll do that, or adjusting sector allocations, and that came in at 45%. Despite planning to increase investments, nearly half of the respondents say they plan to add some protection or hedges in order to manage risk in their portfolios. So where do investors see the greatest opportunities for investment in a Trump administration? Well, as you can see here, they think that finance and real estate will have the best showing, and that's followed by industrials, oil and gas, and defense. These are, of course, traditionally highly regulated sectors that could benefit from Trump's efforts to reduce regulation. And finally, we asked our survey respondents about the expectations for private capital, certainly something that's been widely discussed of late. And the vast majority, 85%, think that President Trump will have a positive impact on private capital firms over the next 2 years. And we've certainly seen a lot of coverage about increase in deal flow to come. So that's a brief look, a high-level look at our investor research, and really looking forward to the panelists' insights and conversation around it. So Sean, I'm going to turn it back over to you to get started.
Great. Thanks so much, Lisa. Sam, I'll turn it over to you to moderate the conversation for the next 30 minutes or so, and then we're going to go to the audience for some questions. So audience, please feel free to put your questions in the Q&A box that should be there at the bottom of your screen. All right, Sam, over to you.
Awesome. Well, thank you so much for having me. I want to start with the survey results that Lisa just shared. Philip, Kathy, do you have any surprise? Was there anything surprising about what was in those findings, or anything that kind of struck you as odd or unusual? I'll start with you, Philip.
Thanks, Sam, and great to be here, everybody. Yeah, I think the survey results, in my opinion, are consistent with my expectations. If you think about the Republican or the Trump policy agenda, they can be viewed as pro-growth and less about regulation. And so I think if you think about the outlook, for the economy on that basis, given some of the proposals around potential tax cuts, lower regulation, I think that broadly speaking makes sense to me. But I think there is some nuance. We talked about the trade policy. I think that potentially is a negative that we need to think about. That can be a significant source of uncertainty out there. And it is interesting to see that sort of the uncertainty around tariffs and the trade policy has not sort of been weighed a bit more by the respondents. But certainly capital markets, agree with that assessment that generally people feel like this will be positive for the economy and stock returns.
We're going to have a ton on trade throughout this conversation, I promise. But Kathy, wanted to see if you had any thoughts on just initial takeaways from that survey.
Yeah, thanks, Sam, and happy to be with everyone. I would really echo Philip's comments. I think, the reaction you're seeing in financial markets and with the equity market rallying so strongly really support or reflect what is found in the survey results, that, investors overwhelmingly, anticipate that the next Trump administration will be very, pro-growth. As Philip said, deregulation is a big item. And, that just kind of paving kind of the way for animal spirits to be unleashed, I think is the best way to think about it. But I would agree with Philip too, that, and I know we'll talk about it, Sam, but I do think that there is a great uncertainty around trade and tariffs, policies, and also immigration. So, and the tax cuts, that's going to be something that's discussed all the way through 2025, what to do and how, what to extend or maybe increase tax cuts at the end of 2025. But that's really becomes a 2026 story for the impact on the economy.
Got it. There is a little bit of a trade component to this next question here. Some of the sectors that folks identified as potential targets in the new administration: finance, real estate and CRE, industrials, oil and gas. Those would be affected many of those would be affected to a certain extent by major shifts in trade policy. I'm thinking specifically about oil and gas. Trump hasn't specifically said whether or not energy imports specifically would be affected by new tariffs. So were you surprised at all by the sectors that institutional investors identified as priorities going into next year and the following years, or were they more or less what you would have expected?
Look, from my perspective, financials and real estate, if you look at the earnings profile of these sectors, a lot of the earnings come from more domestic sources. And so thinking about it from a public equity perspective, certainly those would be sectors that will perhaps be less susceptible to tariffs. I think it's also the regulatory dimension there, as well that perhaps has favored, those areas. Those are sectors that tend to benefit from more M&A, less regulation, more certainty on that front. And then also on the capital requirement side, thinking about banks and perhaps to some extent real estate companies relying on bank funding. And so I do think if I think about some of the policy proposals out there and how those policy proposals might impact different sectors, financials, REITs, or real estate as a sector in general, it definitely stands to benefit, in my opinion, in terms of from those policies. I don't know if Kathy has a different view there.
No, I strongly agree with you on that. And particularly the banking sector, financial sectors are, we've seen equity prices soar on just that very expectation of lessening the regulatory burden, rolling back, and having a new head of the SEC and also within maybe the Fed Reserve eventually having a new head of kind of like bank regulation, all very positive. I'd say the one sector, where it kind of it's uncertain, like with technology, like, yes, deregulation is very positive, but as you mentioned, Sam, tensions on the trade front with China or increased tariffs could be disruptive, or at least a negative headwind for technology firms, and particularly because with China, there is a big large amount of imports of technology related goods that we get from China, so that could be something that is an adverse impact.
That makes sense. And I'm very glad that you brought up the Fed, because that segues very nicely into my next question, which has to do with, I think, the big question around economic policy, which is the future of the Fed. President Trump over the weekend said that he would not try to remove Jerome Powell prior to the conclusion to his term as chair. He's also made some noise in the past about how much say the president should have in setting rate policy. Do you see the election results influencing inflation in any meaningful way in that regard? And what might this mean for the Fed's path moving forward?
Well, first on the independence front, I think it is, the markets would applaud the idea of, keeping Chairman Powell in his role until his term expires. And really all the Fed governors, I think, less meddling with that, with those officials and the roles, it would be really appreciated by the markets, because they don't want to see the Fed lose its independence. Because the risk would be if any given president, not just President Trump, but any given administration had undue influence, it could lead to bad policy choices by the Federal Reserve, and one of the outcomes could be, inflationary, or if interest rates were pushed lower than they otherwise would be. So I think that's good news, but President Trump will have an opportunity to fill some key Fed governor roles in, particularly as these tenures roll off. Not that he would demote them, but as their terms expire, he will have an opportunity to fill those. So that can be quite interesting. And under the first administration, he had nominated a number of people to fill those roles, and they were not seen by market or many investors as being very prudent choices. And the Senate actually blocked those nominations, right? And they didn't get confirmed. So it'll be interesting to see this time if, because the Republicans controlling the Senate, maybe they'll be more apt to, the administration to get through their nominees. On the other hand, maybe there would also be this, the market disciplines, policymakers in making sure that they pick people who would be reasonable. Because I think that, especially with the equity market performance being so strong, one would think the last thing the Trump administration want to do is jeopardize that, right? And have the markets react badly.
Bill, did your outlook on interest rates or inflation change at all after the election? If so, how did that affect how is that affecting your decision making?
Yeah, great question. I would say, the independence question, kind of leaving that to the side for a moment. I think, the pro-growth policies and also the election outcomes around, there being a unified government effectively has, led us to increase our particularly interest rate expectations. And so, we think that there's probably going to be a cut this month and then a couple more next year, but it will be a more shallow interest rate cycle. At the same time, I think where the risk to the upside exists is really coming from that tariff side of things as it relates to inflation. I think we've been on a positive trend there with moderating inflation, probably going to be around 2.5% in 2025. If there's significant tariffs, however that's going to be calibrated, I think there's a risk to the upside there, and that would also have an impact, of course, on interest rates. And so we have adjusted our view there. I actually think markets, back in September probably were underpricing inflation risk, and so that was a good entry point for things like TIPS, Treasury inflation protected bonds, for example, at the time. But yeah, markets have sort of caught up with that view since then.
And just moving ahead then, how would you continue to adjust if these economic or trade policies do prove to be more inflationary over time?
Yeah, it's a great question. So, we take a long-term perspective, and so I think from a inflation perspective, we want to make sure that we don't have too much duration risk. And so I think if you think about our positioning today, we don't own a tremendous amount of long-term bonds. We think the intermediate part of the curve, sort of 5 to 7 maturity range, is kind of where we think the best reward for risk trade-off is today, because cash rates have been coming down with cutting interest rates. But yeah, I think one of the things, markets are forward looking, and so if tariffs are imposed, there's a chance that markets might overreact and actually all of a sudden long-term treasuries look attractive. And so we'll kind of take it day by day on that front. But yeah, it is something we'll be watching. And certainly is one of the potential left tail events as we go into 2025, and as we're getting more knowledge as to how that trade policy, the tariff policy, is going to be implemented by Trump and Congress.
I'm glad that you brought up longer term treasuries, because that actually segues well into my next question for Kathy. Fiscal policy is going to be a big question mark for this administration. Scott Bessent, who is President Trump's pick for Treasury, he's been a deficit hawk over the years. That said, the GOP under Trump hasn't necessarily been known for running surpluses. So what impact do you see the president's fiscal policies having on interest rates and government bond yields moving forward?
Yeah, well, again, to kind of cite, market movements, what we have seen, since the election is 10-year yields have a bit more buoyancy, and part of that, like when you break it down, it's really more about the term premium. So as Phil said, expectations of Fed rate cuts next year have been pared back since September, and that alone will push 10-year yields higher. But on top of that, it's this term premium, which is basically a catch-all for everything except what the expected short-term interest rate path going forward. And part of that is the fact that the concern that deficits may be larger than even the bad, I would say, high estimates are out there now. We are definitely on an unsustainable path with our deficits and debt. That said, we've been able to still fund our deficits and debt quite well. I mean, sometimes whenever there's an auction that goes badly or maybe tails a little bit, there's concerns that, deficit's a problem. But overall, you're looking at, a little bit above 4% of the 10-year yield. That still shows a lot of confidence that, or maybe we're the best place, we're the best of the worst, right? For foreign investors, that they're still willing to underwrite our debt. But I do think that that term premium turning slightly positive is a reflective of some concern about, really what are we going to do? How are we going to rein in or tame, the deficit profile going forward? And as you said, neither, and that was with either, whether it's a Democrat or Republican, to be honest, there was concerns even going into the election on that front.
I mean, have you seen anything in his agenda, in President Trump's agenda, that would, suggest that our fiscal outlook might improve next year or in the coming years? Because there was a lot of hay made over the course of the campaign about what deficits would look like under Trump versus Harris. Certainly the Harris campaign made a lot out of that. Just curious if there's anything that you've seen specifically that suggests that they are cognizant of how dangerous this could be.
And I think that, as you mentioned, Bessent at being, Treasury Secretary or likely to be confirmed Treasury Secretary is would be a good step. And he is a hawk, so that should bode well. And I think they're aware of the issues. I think, will determine, what they actually do in terms of action, right? Is there really going to be spending reform under this DOGE, advisory group, right? Headed by Elon Musk, are we really going to see some changes? The issue is that really this, which has been the case for a long time, most of the spending pressure is coming from entitlements. Yes, you could probably cut some fat out of discretionary spending, but defense is tough to touch. interest costs are now one of the largest, increase sources of upward pressure, and that's a reflection of previous, deficits. So that's hard to mitigate. Maybe with lower interest rates, the rolling over, the interest costs will go down a little bit, but it'll be interesting to see what comes out of that. And I think we're kind of in a wait and see mode to see what actually plays out.
Got it. I want to flip it back to you here, Phil. Confidence has been super high coming out of the election. In fact, I was looking at the Business Roundtable CEO survey that came out today. NFIB was out today. Both of those jumped quite a bit. We've even seen it on the consumer side as well. But curious if you see anything on the fiscal front, the conversation I was just having with Kathy, if you see anything on the fiscal side there denting that confidence moving forward or aiding that confidence moving forward. I wanted to kind of make sure I'm flipping the same type of cue to you here.
Yeah, no, I think that's consistent with kind of the the survey results we're discussing here and at the beginning. I think CEOs in general, seem to be supportive of the pro growth agenda more broadly, and so I think that doesn't surprise me. I think there's a survey of small business owners or smaller firms that also jumped significantly in recent weeks as well. And so I think that's consistent with the pro-growth deregulation agenda. I think on the fiscal side, generally, I think businesses, generally like, kind of government, as long as taxes don't go up, I think more spending generally is supportive of businesses. But I will say again, going back to maybe the trade issue, but also very specific, policies or industries. If you think about, if you're an executive in healthcare, today with, as the potential appointment in that area, I think there's probably some uncertainty there. At the same time, if you're working for a retailer who imports, Best Buy or one of the big importers of goods from overseas, I think that is going to be a different story there. If that's a business you're focused on. But yeah, I think the statistics you're citing are consistent with my expectation, in line with sort of that pro-growth posture that the administration has been signaling.
I'm going to put a little bit of a finer point on it, which is, we talked about Doge a minute ago. Doge is, Musk has said potential to cut as much as $2 trillion from the budget. You just said that spending is ultimately, something that benefits businesses. They prefer to see government spending money. Is there going to be a period when you expect the rubber to meet the road where cuts that are, recommended or imposed by Doge or lawmakers who are working with Doge has any sort of dent or any sort of negative effect on business sentiment? Or is the lower regulation, lighter tax that, is likely to come in the next couple of years here going to be enough to kind of supersede that?
Yeah, I think there is a potential for there to be impacts. My guess is it's going to be more at the individual sort of sector industry level as opposed to a broader brush. And so, defense being one of the line items that, is kind of part of the broader budget. My guess is that's probably not the first line item that they will look at, but I think it sounds like they will start with, more obvious productivity gains and just making the institutions more productive. But I think the trillion number, people have, the 2 to 3 trillion number that people have floated as a goal, I think that'll be tough to achieve given some of the, kind of the breakdown of the spending that Kathy's talked about. So we'll have to see where we'll end up. But my guess is that it's going to be more pointed more at an individual sector level where those impacts might be felt.
Understood. Sean, I promised I didn't forget about you. Have you seen any uptick in requests from clients or from new clients on how they should be communicating with folks in Washington moving forward now that we're in a very different administration, or we're about to be in a very different administration than the one that's leaving?
Yeah, no, absolutely. I mean, think about it. It's just 41 days until the inauguration, and really companies are quickly looking to bolster their DC presence in anticipation of really needing to protect their reputations and insulate them from, or in many cases, take advantage of these proposed policy changes. They're really looking for insight and really looking for help to peer around corners. basically every company needs to have a Washington strategy, have a clear understanding of the people, the personalities, the policy, and how your company is going to be impacted. So we're seeing a lot of pre-game work being done right now, where companies are really mapping out the new administration, identifying connections, and trying to get meetings now when it's much easier to access these individuals who will soon be administration officials. So they're looking to see, where they can draw the lines of connections. Who knows Paul Atkins? Who knows Scott Bessent, Susie Wiles, John Thune, Andy Barr, so on and so on. It's really looking to make those connections now while they can and map out a strategy for the next 4 years.
And what do you think that they need to be prepared for on the communications front? Because on the one hand, having relationships with folks in the administration is helpful. On the other hand, President-elect has been known to make his opinions known suddenly, sometimes on Truth Social, sometimes on X, at times that may or may not be inconvenient for New York or Washington-based reporters.
Yeah, it's really taking a different angle from communications. First, you need to have a clear understanding of the policy agenda and how it will impact your individual company. You really also need to be able to sift through all the noise and determine what's real and what's rhetoric. You need to really know who the decision makers are, right? Because you don't need to be communicating with all 535 members of Congress when really there are only a handful of specific members who have the pull to impact the policy that you're focused on. And then it's really realizing that it goes beyond the elected officials. You need to know who the chiefs of staff are, legislative directors are, and so forth. You really need to know how to target them with your messaging. You also need to be able to communicate with a whole batch of new reporters. I mean, social media influencers and podcasters. There are so many platforms out there that you really need to know which ones are the most effective in reaching your target audience. And finally, you really need to be working to build alliances and partnerships in Washington through these trade associations, leadership groups, and think tanks. You want to make sure you're really aligned with the influencers in your industry.
I want to pivot back to economic policy for a moment here. We mentioned at the top, and it's come up a couple times, how tariff and trade agreements might impact the outlook moving forward. Kathy, just more generally, I mean, are there any concerns about how changes to tariff or trade policy might affect America's competitiveness globally in the years ahead? Some of this stuff is pretty protectionist.
Yeah, no, absolutely. And, traditionally, tariffs are not usually seen as good trade policy, especially by economists for the reasons you say. It could protect and shield, certain industries or sectors that then that hurts productivity overall and competitiveness. So, typically it's seen as being, better to embrace kind of a more freer trade environment. That said, the critics will say of that, well, China hasn't been operating in a very free way and sort of been subsidizing their companies, and that's adversely affected our workforce and our companies. So it's not a clear-cut issue, but I think in general that would be the one thing I worry about, besides potentially higher inflation for consumers or businesses, would also be the impact it has long run, medium to long run on competitiveness, because ultimately that's really the greatest underpinning of economy is how competitive your firms can be and sectors, because that could breed productivity gains, which is really what, again, ultimately is kind of the ultimate prize for economics and economic growth.
Bill, are you doing any reevaluating on how you approach foreign markets based on the trade and tariff discussions that have been percolating for the last few weeks here?
Yeah, it's definitely something we're paying attention to. I guess the nice thing about an election compared with other capital market events is that you sort of know what the outcomes are, and so you have the ability to prepare. And so we knew who the candidates were going to be. We knew what the different calibrations and permutations were going to be from an election standpoint. So for us, it was really a matter of preparing for the outcome and making sure that in terms of the construction of our portfolios that we were positioned in a way where we were not overly exposed to one particular area. So we do own some Chinese companies, but when we own Chinese businesses, we try to pay attention of their business models and to what extent those businesses are exposed to foreign trade. And so we like some of the domestic tech firms, consumer-oriented firms that are less exposed to the trade side of things. And so I think it's a matter of really doing your homework and understanding to what extent the positions you're taking in your portfolio might be exposed there. Now, I will say that some of the trade exposed areas, if you think about the markets in Mexico or Brazil, Korea, if you look at their valuations today, they actually look relatively attractive. And so there are cases where market participants overreact to this information. And if you're a long-term investor, you can actually take advantage of these things. But it's absolutely important to understand the range of outcomes and making sure that you're not overly exposed to a potential negative tariff outcome. And of course, there's a huge amount of leeway that the president has in terms of slapping tariffs on countries and ratcheting them. And it's not clear whether it's permanent or if it's just a negotiation tactic. And so, but yeah, absolutely something that we pay attention to.
I would think that the question of whether or not it's universal versus targeted as well would be a component here. I mean, how has that factored into those discussions on sort of how you're preparing for a more tariff-heavy environment?
Yeah, I think it needs to be part of the scenario analysis. I think I would say across the board 10% tariff that would be the most significant if you think about the economic impact. And Kathy might agree with that assessment, but if you just think about the impact and just the trade relationships the United States has, that will be the most significant as far as the dollar amount of tariffs. I also think that tends to be probably the least likely. I think tariffs focused on particular trade partners, whether it's China or Mexico, are probably more likely. And then something that's perhaps more nuanced, more focused on particular industries, whether it's the auto industry or certain types of manufacturing products, that would be probably the most likely.
Got it. This is a bit of an unusual incoming administration in that we've already had a Trump administration before, 4 years ago, 8 years ago now. So I'm wondering what lessons, Philip and Kathy, that you're taking from maybe Trump 1.0 or perhaps another administration to prepare your firms, prepare your clients for any future changes that might come in this second iteration of a Trump administration.
Yeah, I'm happy to take a stab at that. I guess leveraging what Phil and also Sean said is, one, keep in mind that what is rhetoric may not become policy. We don't know, right? It's we saw under the first Trump administration that there was lots of talk about tariffs, against autos from Europe or perhaps Mexico and China and Canada, and it never played out. And ended up what we got was steel and aluminum tariffs, and then about 25 to 30% increased tariffs on China. That did play out. So I guess with our own forecast, what we're assuming in our baseline for now is we get another 30% increase or so across the board against China imports. But it's really speculative at this point that we'd even get any tariffs against Canada and Mexico, and if that, even with if that's legal through executive action to do that, because it's one thing to kind of stretch things and say, well, we're doing this for national security purposes vis-a-vis China. A little different to do that first Canada and Mexico. So I think we're waiting to see, but we've made some incorporation to reflect probably something against China seems a bit easier, and the path of least resistance, and also because Democrats also could support that.
Bill, do you agree there with China being a more likely target here, given the political dynamics?
I think China is clearly one of the targets, and so I think that's probably one of the more likely targets. Is my audio okay?
Philip, can you? I think your audio might be a little garbled there. We're doing it on the fly. Excellent. Oh, I think you need to adjust your audio input in the left corner. So
Okay, am I back?
There we go.
Apologies.
there you go.
Yeah, so on the China question, yeah, I think that seems to be the main target. You know, going back to kind of the original question though about the lessons, I do think, you know, chances are, you know, it is part of a negotiation tactic. I think in May of 2019, you know, there was a threat of 25% tariffs on Mexico, and then there was a sort of a ratchet sort of mechanism. You know, it started at 5%, and ultimately there was an agreement reached. And my guess is some of the tariffs will have that effect. But taking a step back, and you know, you talk about the lesson. I do think if you listen to Trump, and we've seen one presidency already. If you you know, look back at one of the first interviews he did, I think it was a Bloomberg interview mid-year. I do think that if you know, Trump wants to leave a legacy, I think he's serious about restructuring trade agreements and you know, bringing you know, restructuring for the manufacturing, I think, side of things. And so I think the notion of, you know, putting tariffs on trade partners and then using those proceeds to potentially bring taxes down, I do think is actually something that he would like to achieve as one policy, one key policy agenda that he has. And so I don't think it's just rhetoric. I think it's in some cases it is. I do think that he cares about that legacy, and I think we should pay attention to that.
Sean, I want to go back to something that you mentioned before, which is, you know, the importance of kind of knowing who the power brokers are going to be in an incoming administration or an incoming Congress. One thing that's a bit more, I would say, unusual about this transition has been the degree to which business leaders have been playing a more vocal role. Elon Musk obviously leading Doge, David Sachs coming in as a AI and crypto czar. I mean, what role do you think business leaders should play in shaping policy, and what role do you think they ultimately will play in shaping policy under this new administration?
Yeah, I mean, Sam, you pointed out this is a very unique moment where the administration is bound to be filled with many, many business leaders, and they're going to be very influential and steering the economy going forward. But business leaders in general, when they're looking to shape policy, it really depends on the industry. Business leaders really need to ensure that they remain focused on the issues that are really relevant to them, that are impacting their business, their clients, and their employees. It really needs to be authentic. There really needs to be a reason and a greater thought before wading into policy issues. Because the reality today is that every issue needs to be looked at through a new lens with tough questions and really analyzing that risk. I mean, social activism is much different today than it was 4 years ago. And, you know, companies need to be prepared for the potential of increased scrutiny. The Robbie Starbucks of the world are real, and you really need to know how to navigate them.
That actually segues pretty well, because I was going to ask Kathy and Philip about regulatory and policy impact. Now, obviously, there seems to be within the business community this sense that regulation is going to be perhaps a bit easier to navigate in Trump 2.0, but I'm curious what changes in federal regulations or policy you see that you're focusing most on currently, and what impact do you think that those changes might have on the economy writ large? Kathy, I'll start with you.
Yeah, thanks, Sam. Well, we had spoken earlier about, you know, the financial sector and banks. You know, if it's done well, the deregulation could unleash new credit expansion, and that could help fund you know, economic growth, you know, going forward. There's always a risk, though, if the pendulum swings too far the other way, you know, that could be risky, right, for the medium to long term. You know, that's the one caveat. But I do think, you know, there was an enormous amount of regulations, you know, put in place under the Biden administration. And I think, you know, the regulating or rolling back some of those could be beneficial, again, to credit creation. I would also say that, you know, seeing that in technology, you know, though it cuts both ways on trade, but, you know, overall, that could also be very positive. So those are two sectors that we're looking at from like a macro perspective.
Gotcha. Philip?
Yeah, maybe adding to the list that Kathy started. So I think in my mind, there's kind of a broad level set of policies. I think taxes, tariffs are probably in that broad level. But then if you drill down to sectors, Kathy talked about banks. I think energy is going to be a key focus. Also, a big part of the plan that the Treasury Secretary has. And so I think the impact that has on the potential volume of energy production in the United States, I think that's going to be a key focus. We had positions in midstream energy companies that operate infrastructure, and so these companies had a tremendous 2024, and in some ways almost I think we've taken profit in those areas just because they've done so well. So energy is another one. I mentioned healthcare. If we talk to our healthcare team, they're looking at companies with vaccine exposure, and they do think that there's some uncertainty certainly in the near term on those businesses, companies that are very much focused on production and distribution of vaccines as one of the areas that could be impacted.
Gotcha. Last one, and this is just kind of a more broad volatility question. We've spent a lot of time talking about trade and tariffs, but just more broadly, are there any other kind of major events or major concerns that you have that could trigger volatility with Trump returning to office next year?
Yeah, happy to start on that. So I think that, the question, we haven't spoken a lot about it, but, with immigration, how is that handled going forward? And is it done in a, constructive way, or does it become destructive for certain sectors that rely on, immigration, and even the undocumented workers, like you think about the construction worker or the farm business. And I would also say, taxes, is going to be something we hear about, like discussed a lot through 2025 as, $4 trillion or so expire at the end of the year. And how, what's extended and what's the cost, right? Because I think just extending what's in place now, plus the interest cost is like $4.6 trillion. So
yep.
Is there going to be pushback too, even within the Republican Party, for going above that? I think that'll be quite interesting for us to digest.
Great.
Yeah, maybe just adding to the list of risk. I think from my perspective, geopolitics is something to keep in mind as well. We're at a point where I think we have a lot of challenges, whether it's in the Middle East, whether it's in Ukraine, potential impact of trade war between U.S. and China relations, and so I think there is some headline risk there. There's a significant degree of uncertainty, and so I think that can be a cause of significant volatility as well.
Got it. Well, I am handing off moderating duties for the final 10 minutes here to Sean, who's going to take some questions from the audience.
Yeah, thanks so much, Sam. So we'll turn to the audience for some questions. I mean, by all means, please feel free to ask your questions in the text box below on your screen. But before we start, I want to turn the tables and pose the first question to Sam. So, Sam, you're very plugged into Washington and Wall Street. What issue are people really not paying attention to that they really should be?
I think a big question mark for me going into next year is going to be antitrust. There was a lot of optimism that I heard from folks, particularly in the banking sector, prior to the election and when Trump won, that brighter days are here for bank mergers. His pick for DOJ's antitrust division, Gail Slater, is definitely somebody who has been more aligned with a bit of a more populist wing of the Republican Party over the years.
JD Vance, right?
Yeah, exactly. JD Vance. She was an advisor to Trump in the past on tech. I'll be really interested to see how she approaches financial services mergers and antitrust after Jonathan Cantor. So I think that's a really big question mark for me moving ahead. And the other thing that I had a conversation a couple months ago at the Greenwich Economic Forum with Dan Zinn from OTC Markets. And he made the point to me that, in 2016, when Trump won, there were a lot of folks in the financial services world who were super excited about him coming in and likely appointing regulators who are going to be friendly to industry writ large. Jay Clayton, his SEC chair in 1.0, took a very specific interest in OTC markets. And so for Dan, that, they ultimately got to a place where things worked out, but there was quite a bit of work that they had to go through in order to get their business, in line with what Chair Clayton had in mind for those markets. So I feel like there's been a little bit too much exuberance at this stage, and I'll be very interested to see that start to come back to earth as more appointments are made, and as those appointees, assuming they're confirmed, start to make their priorities a bit more known to industry.
So Sam, I want to take advantage of this situation because I think people really do appreciate hearing your insight as well. So we've talked a lot about the Trump administration just giving a light touch to regulation. What does that mean to you? What's that light touch mean to you?
Well, I think like the most obvious example is probably going to come in like the crypto industry. SEC was quite aggressive under Chair Gensler, levying enforcement actions against crypto firms that they said were violating securities laws, in certain cases, perhaps perpetuating frauds. I will be interested to see how the SEC navigates that marketplace moving forward, particularly during the period when there may not be a crypto regulatory framework to work in. It takes time to pass legislation. There are obviously a number of other high priority issues, tax policy being one that Congress has to tackle next year. So if we are in an era where markets are exuberant, and we're seeing that right now with Bitcoin, climbing above 100,000, and more folks are pouring into crypto, that is a similar dynamic to what occurred in 2022 when a number of these firms collapsed. I'm not saying that any of these firms are about to collapse or anything along those lines, but when there's that much exuberance, if the economy hits headwinds, if the crypto market hits headwinds, the SEC is likely going to have to navigate some crypto entities that may or may not have been operating well. I'll just leave it in that way. So I think that that's one area where I think there might be some stories in the next couple of years, whether or not sort of how the SEC navigates that space specifically.
Thank you, Sam. Couple questions from the audience. So Philip, Kathy, to you. First, Philip, Kathy, jump ball. What was the most surprising market reaction to the election results?
Well, I think from my standpoint, I would have expected small caps to do well, dollar to strengthen. I think that was obvious. I do think that the crypto move, in my opinion, if the magnitude of that move was quite surprising, and then just a knock-on effect to the meme stock and just kind of the areas that look expensive. I think I did not expect that to happen. Sort of that momentum trade, how quickly it moved from some of the more obvious places like small caps to creating some frothiness, I think, in parts of the market.
Yeah, I would say that maybe no real stark surprises, but maybe just the degree and the swift movement in prices, especially the equity market, and just this euphoria that we're seeing. But again, maybe not surprising, but maybe just the degree of it.
So another question coming in from the audience that really builds off of that. Has Trump's re-election emboldened private equity firms and strategies to engage in M&A activity?
I think so. If you look at some of the key beneficiaries and you look at capital market returns, the return of Blackstone, KKR, for example, the stock price, also some of the investment banks. And so I do think that there's clearly an expectation that's going to be easier for there to be deals and less scrutiny on that. And I think that's probably a fair assessment by the market.
Let me ask you a question coming in from the audience regarding ESG. What do you think the impact might be, Trump's election might be on ESG? Do you see investors having, quote, less belief in ESG integration as a risk tool? Or do you think investors will continue to evaluate these factors, but simply communicate differently or not communicate at all?
A great question. I think some of the shine has come off of ESG, and I think, you know, think about, you know, the more traditional, you know, engines of growth and sectors, they seem to be, you know, probably getting a lift, or at least that's the expectation. So I think it would become, you know, a little bit tougher, just some of the shine coming off the ESG, but I think, you know, there's still fundamental underpinnings for that sector. That will continue, but just not as, it doesn't shine as brightly.
Yeah, I would echo. I would first of all say I think that conversation has been happening for a couple of years. Morningstar has an ESG data business. We own Sustainalytics, and so I think that Europe it's clear that is continues to be a key focus there. It certainly has been politicized in the United States, and I think a Trump victory, probably will not change that. But I do like, as an investor, myself looking at companies, I do like, kind of the ESG and ES&G lens as just an additional lens to look at. What does governance look like in this company? Is the board diversified? What's chairman versus CEO role? These types of information sets are useful for long-term investors as well, independent of any value judgment. And I can anticipate perhaps the industry shifting in that direction as well, particularly in the United States.
Somewhat related to ESG, focusing on the E component. Question from the audience: do you believe that institutional investors will change their outlook on the speed and scale of the energy transition? And if so, what types of strategies do you see playing out? So do you see energy transition continuing at full speed ahead or being scaled back?
So I probably defer to Phil on this, but I guess in terms of, you mean a transition to cleaner
yes, clean energy. Yeah.
Yeah, I think it slows down a bit. It's just the tailwinds are going to be offset by some of the headwinds here, and there really is a shift more towards away from that and more towards tradition, as Phil said, really focused on bringing back manufacturing sector and jobs here, and a focus more on the kind of traditional portions of that sector, not so much having support or government support or subsidies or anything for the greener portions of that. Yeah.
Yeah, I think if you look at solar companies, for example, some of the most impacted companies, post a Trump election, just given the presumed shift in policy there with federal support potentially, and so I do think it will change things. And there's an interesting dynamic with Elon Musk, kind of being sort of influencing the president as well, and so we'll see how that will impact potentially the focus on EV and also kind of the solar story down the line.
Great. And one last question from the audience, and Sam, this is actually specifically to you. The audience member is asking about crypto, talking about all the exuberance with crypto in the Trump administration, but asking if you think this administration will also be cautious with regards to all of the fraud that still exists in the industry. Like, will they still be policing crypto as much as they had been with Gensler no longer being there?
I think that's a great question, and I think that's a bit of an open question. I have no doubt that folks in the administration don't want to see fraud in the marketplace, but to the earlier point, when there's that much exuberance in the market, that is where there's opportunity for fraud. And we'll have to see if Atkins is approved, what enforcement looks like under his tenure, because the level of enforcement that was at play under Gensler and with Gurveer Grewal was clearly something that the industry chafed at, and the industry has quite it's a big voice in the administration's ear at the moment, clearly.
So well, looking at the clock, that's actually all the time that we have today. It's been a fantastic conversation. Lisa and I want to thank our panelists, Kathy Bostjancic, Chief Economist from Nationwide Mutual, Philip Straehl, Chief Investment Officer for the Americas at Morningstar Wealth, and a special thank you to Politico Sam Sutton for moderating. And be sure to subscribe to Morning Money to hear more insight from Sam each morning. And finally, many thanks to all of you for joining us, and we wish you nothing but the happiest of holidays. Thanks so much and have a great day.
Thank you all.
Thank you.